Imagine getting a pay cut every single year that never shows up on your payslip. No email from HR, no meeting, no warning. Your salary number stays exactly the same, yet somehow your money buys less than it did 12 months ago. This is not a mistake, and it is not bad luck. It is inflation, the slow and silent force that quietly drains the value of every dollar you earn. Most people feel it at the grocery store or the gas pump, but very few understand how it actually works. In the next few minutes, we are going to break down exactly what inflation is, why it happens, who it hurts, who it secretly helps, and most importantly, what you can do to stop it from eating your future. At its core, inflation is simply the rate at which prices rise across an economy over time. When economists say inflation is 3%, they mean that on average, the things people buy cost about 3% more than they did a year earlier. It is not about one product getting more expensive because it went out of style or became rare. It is a broad, general increase in prices across food, housing, transport, healthcare, and almost everything else. The key idea to hold on to is this: when prices rise, the purchasing power of your money falls. Each dollar in your pocket now controls fewer goods and services than it used to. The money looks the same, but it quietly does less work for you. Economists use two words that explain almost everything about inflation: nominal and real. Nominal is the number you see, the price on the tag, the figure on your paycheck, the balance in your account. Real is what that number can actually buy after you strip out the effect of rising prices. Here is why it matters. If your salary goes up by 2% but prices go up by 5%, your nominal income increased, but your real income actually fell by 3%. You have more dollars, but those dollars command less. Understanding this gap between nominal and real is the single most important step to seeing through the illusion. The economy constantly hands you bigger numbers while quietly shrinking what those numbers are worth. Let us make this concrete with a simple example. Picture a basket of groceries that costs $100 today. Now assume inflation runs at 5% for the year. Next year, that exact same basket, the same bread, milk, eggs, and vegetables, will cost $105. You did not buy anything extra. You did not upgrade to a fancier brand. The contents are identical. Yet you now need $5 more to walk out with the same bag. Multiply that across rent, insurance, fuel, and every bill you pay, and you can feel how quickly it adds up. This is the heart of inflation. Your money simply does not stretch as far as it once did, even when nothing about your lifestyle has changed. This brings us to one of the most frustrating truths about modern work. Many annual raises are smaller than the real rate of inflation. Suppose your company gives you a proud 3% raise, but inflation that year is 6%. On paper you got more money. In reality, you just became poorer. Your purchasing power dropped by roughly 3% despite the raise. This is why so many people feel like they are running faster and faster just to stay in the same place. Their income keeps rising, but their standard of living stays flat or even slips backward. The raise feels like progress, but inflation quietly claws most of it back before you ever notice it is gone. So how do we actually know what inflation is? Governments track it using something called the Consumer Price Index, often shortened to CPI. Statisticians build a representative basket of goods and services that a typical household buys, then measure how the total cost of that basket changes over time. If the basket costs more this year than last, the percentage increases the inflation rate. It is not perfect. Everyone spends differently, so your personal inflation rate might be higher or lower than the official number. Someone paying rising rent and medical bills may feel far more inflation than the headline figure suggests. Still, the CPI gives us a shared yardstick to understand whether prices are creeping up gently or spiraling out of control. Inflation does not come from nowhere. Economists point to a few main drivers. The first is demand pull inflation, where too much money chases too few goods, so sellers raise prices because buyers are willing to pay. The second is cost push inflation, where the cost of producing things rises, maybe because of expensive oil or disrupted supply chains, and businesses pass those costs on to you. The third and deeper cause is the money supply itself. When a central bank creates a lot of new money quickly, each existing unit of currency becomes a little less scarce, and therefore a little less valuable. Usually, real-world inflation is a messy blend of all three forces pushing on prices at the same time. Inflation is not neutral. It quietly picks winners and losers. The clearest losers are savers who keep large amounts of cash sitting still. If your money earns 1% in a bank account while inflation runs at 5%, you are losing 4% of your real wealth every year, even though the balance looks safe. People on fixed incomes, like some retirees, also get hurt because their payments do not rise as fast as prices. Anyone holding wealth in plain cash is slowly bleeding value. The cruel part is that it feels safe. The number never drops. But safety in nominal terms can be a slow and steady loss in real terms, year after year. Now for the surprising part. Inflation can actually help certain people, especially borrowers. Imagine you borrow money to buy a home with a fixed interest rate. As the years pass and inflation pushes up wages and prices, the amount you owe stays fixed in nominal terms, but it shrinks in real terms. You end up repaying the loan with dollars that are worth less than the ones you borrowed. Governments with large debts benefit in a similar way, because inflation quietly reduces the real burden of what they owe. This is why inflation is sometimes described as a hidden transfer of wealth, moving value away from savers and lenders and toward borrowers, often without anyone voting on it or even noticing. To really appreciate inflation, you have to zoom out and look at decades, not years. At just 3% inflation, prices roughly double in about 24 years. That means the money you tuck under the mattress today could lose half of its purchasing power within a single working career. A comfortable sum saved in cash for retirement can quietly turn into a fraction of what you expected. This is the danger of thinking only in nominal terms. The balance stares back at you, unchanged and reassuring, while its real power drains away silently in the background. Time, which is supposed to be an investor's greatest friend, becomes an enemy for anyone who leaves their wealth sitting idle in cash for too long. So what can you actually do? The strategy comes down to two ideas. Grow your income faster than inflation, and put your money into things that tend to rise with prices instead of losing to them. Negotiate raises with inflation in mind. Build skills that increase your earning power, and create additional streams of income. Then, rather than hoarding cash, consider assets that historically outpace inflation over the long run, such as broad stock market investments, real estate, or other productive assets. The goal is not to fear inflation, but to position yourself so that rising prices lift the value of what you own instead of eroding what you hold. The people who win are the ones who own things, not just the ones who save dollars. Everything we have described so far assumes inflation stays low and steady, a few percent a year, but history shows what happens when it spirals out of control. In extreme cases known as hyperinflation, prices can double in days rather than decades. Workers have been paid twice a day so they could spend their wages before the value collapsed. People carried cash in wheelbarrows, and money became so worthless it was cheaper to burn than to buy firewood. These episodes usually follow governments printing enormous amounts of money to cover their debts. While rare, they are a powerful reminder of what money really is. It only holds value because people trust it, and inflation is what happens when that trust begins to erode. You might think the solution is simply to have no inflation at all, or even falling prices. But the opposite of inflation, called deflation, brings its own dangers. When prices fall consistently, people delay buying because they expect things to be cheaper later. That drop in spending can cause businesses to cut wages and jobs, which reduces spending even further, creating a downward spiral. Debts also become heavier in real terms, the reverse of what inflation does. This is why most central banks do not aim for zero inflation. They target a small, positive rate, often around 2%. A little inflation acts like grease for the economy. encouraging people to invest and spend rather than sit frozen, waiting for prices to fall. Inflation can also feed on itself through something called a wage price spiral. It works like this. Prices rise, so workers demand higher wages to keep up. Businesses grant those raises, but then face higher labor costs, so they raise their prices again to protect their profits. Those higher prices push workers to demand even bigger raises, and the cycle repeats. Once this loop takes hold, inflation can become stubborn and self-sustaining, continuing even after the original cause has faded. Expectations become the fuel. If everyone believes prices will keep rising, they act in ways that make it come true. This is why central banks care so much about keeping inflation expectations calm and anchored in the first place. So who is responsible for keeping inflation in check? In most countries, that job falls to the central bank. Their main tool is the interest rate. When inflation runs too hot, they raise interest rates, which makes borrowing more expensive and saving more rewarding. That cools down spending and investment, easing the pressure on prices. When the economy is weak, they cut rates to encourage borrowing and spending. It is a delicate balancing act. Raise rates too much and you can trigger a recession. Raise too little and inflation runs loose. This is why interest rate decisions make headlines. They ripple through your mortgage, your credit cards, your savings, and ultimately the real value of the money in your pocket. Beyond big investment strategies, a few everyday habits can soften inflation's bite. Review your recurring subscriptions and bills, because prices creep up quietly and loyalty rarely pays. Keep an emergency fund, but do not let huge piles of cash sit idle for years losing value. Regularly ask for raises and benchmark your salary against the market, since staying silent is effectively accepting a pay cut. And keep learning about how money works, because knowledge compounds just like interest. None of these habits are dramatic on their own, but together, over years, they help ensure that inflation is something you manage deliberately, rather than something that quietly manages you without your permission. Let us bring it all together. Inflation is the slow rise in prices that quietly reduces what your money can buy. It shows up as a gap between nominal numbers and real value. It turns modest raises into hidden pay cuts, and it punishes those who sit in cash while rewarding those who borrow and invest wisely. None of this is a secret conspiracy. It is simply how modern economies work. But understanding it changes everything. Once you can see inflation clearly, you stop being its passive victim and start making choices that protect and grow your wealth. If this helped you see your money in a new way, follow along, because understanding how the system works is the first real step to winning inside of it.